Important knowledge enriching session, second study circle meeting. Focus today on financial of non-corporate entities. Now I request to Sri Milind Hendre sir, Chairman of Study Circle Committee, for his opening remarks.
Thank you, Kashif sir. Respected Honorable President of MTPA, Advocate Anudra Chavanji, esteemed dignitaries on the dais, respected past presidents, senior members present here, and those join us virtually. A warm welcome to all of you. As the chairman of the Study Circle Committee, it is my privilege and pleasure to welcome you to the second Study Circle Committee meeting of the current tenure. The Maharashtra Tax Practitioner Association has always been committed to empowering its members with up-to-date knowledge and professional excellence. I am proud to share that this tradition has been carried forward consistently and successfully for several decades, enabling our members across the country to stay connected with the mission and vision of MTPA. While many of us try to keep ourselves updated through reading, webinars, or professional interactions, we understand that the time constraints often limit such efforts. It has been consistently observed that participation in study circle meeting proves to be one of the most effective and practical ways to stay abreast of the latest developments, rules, and amendments in the tax laws and allied acts. This year, we have curated a series of study circle meetings covering a wide array of relevant and contemporary topics. I urge each of you to actively participate, not just individually, but also encouraging your staff and professional colleagues to benefit from these sessions. Today's session focuses on particularly important subject, financials of non-corporate entities. In practice, many of us deal with sole proprietary partnership, LLPs, not registered under Companies Act, trust, NGOs, and professional firms. Having clarity and consistency in preparing their financial is crucial, not only for compliance, but also ensure transparency, better creditworthiness, and smoother interactions with stakeholders such as banks, tax authorities, etc. We are privileged to have tax practitioner Santosh Sharma sir as today's faculty, a well-known respected expert in this domain. I am confident that his guidance will prove us with valuable insight and practical takeaways that all enhance our professional competence and service delivery. Before I conclude, I would like to express my gratitude to all the members of the team MTPA, the Study Circle Committee, and all volunteers who have worked behind the scene to organize this hybrid session smoothly. Once again, thank you for your continued support and enthusiastic participants. Let us continue learning, growing, and contributing to the profession together. Jai Hind, Jai MTPA. Thank you.
Thank you, Hendre sir. Now I will call our President, Advocate Aniruddha Chauhan sir, for his presidential remarks.
Good evening, all of you. Today's faculty, my past president, Mr. Santosh Sharma sir, Joint Secretary Kashif sir, Chairman Milind Hendre sir, Committee Member Ashwini Bilkar ma'am, past president, senior members, a very warm welcome to our second study circle meeting. It's great to see so many of you are today, both in person and online. As you will know, the world of tax and finance is always changing, and we need to stay up to date. Today, we are going to dive into a crucial and complex topic, financials of non-corporate entities. The goal of this study circles is simple: to help us all learn, share, or grow together by making financial statements more uniform and improving account disclosures. We help ourselves and the clients and stakeholders we depend on our expertise. This session is a great chance to sharpen our skills. Share what you know and make sure you can all handle the details of these financial statements. I'm very excited about the knowledge our expertise speaker will share today. Their expertise is invaluable, and I'm sure we will have with a renewed sense of purpose of lots of new information. Thank you for being here. Let's have a productive and impressive session. Thank you.
Thank you, President sir. Now I request our committee member, Mrs. Ashwini Bidkar madam, to introduce today's learned speaker, Sri Santosh Sharma. Bidkar madam, please.
Good afternoon, everyone. Respected President, our esteemed association, Advocate Anurudra Chavan sir, Chairman of this course, Milind Endre sir, today's faculty, Santosh Sharma sir, Joint Secretary, Kailas Kachit sir, and all my seniors and all colleagues participant on Zoom meeting, good afternoon. It's my great pleasure to introduce today's talent faculty, Santosh Sharma sir. Sharma sir is a senior and highly respected tax consultant from Pune with over 35 years of independent experience in taxation, cooperative audits, and trust matters. A former president of Western Maharashtra Tax Practitioner Association, he is known for his dynamic leadership and powerful representation before tax authorities. He is the author of the book Appeals Before CIT Appeals, and his second book on faceless assessment under income tax is currently in progress. He is also deeply involved in social work and has been honored with prestigious recognition such as the Mata Mahalakshmi Jivan Gaurav Award and the MTPA Kohinoor Award 2025. I request all of you, please give a huge round of applause for such a dynamic faculty. Over to Vaishit sir.
Thank you, Bidkar madam. सफलता की कुंजी है ज्ञान. Now I request our president to felicitate today's learned speaker, Sri Santosh Ji Sharma sir, with buffet and moment. Thank you, Sharma sir, for accepting our appreciation. Only with the power of knowledge we can achieve success. Without wasting more time, now I request our learned speaker, Sri Santosh Sharma sir, to start the lecture.
Hello. Respected President of Maharashtra Tax Practitioner Association, Anuruddha Chavan, Chairman of Study Circle, Milinji Hendre, Joint Secretary of the Association, Kailas Kashid, Committee Member, Madam Ashwini Bedkar, past Presidents, Narendraji Sonavne, Prasad Deshpande, Manoj Chitalikar, Shripad Bederkar, and all the committee members, all the members present in the hall and on the virtual platform. I have been asked to speak on the latest guidance note issued by the Institute of Chartered Accountants of India in respect of the financial statements of non-corporate entities. The institute has published a guidance note and has asked opinions from the members before 8th of March 2023. Thereafter, this guidance note has been made effective from financial year 24-25. That means all the non-corporate entities which will be presenting their financial statements, they will have to present their financial statements in the forms suggested by the Institute of Chartered Accountants of India. What the institute has suggested and what is the purpose behind publishing this particular guidance note and the changes in the format. Why the changes in the format has been introduced by the institute. The institute has, the purpose was the financial statements should be more transparent, useful, and comparable. See, unlike the corporate entities are required to present their financial statements in a particular format as the companies, as prescribed under the Companies Act. However, there was no format prescribed for non-corporate entities. However, this particular format which has been prescribed by the institute is for all non-corporate entities. What are these entities? These are sole proprietorship concern, then partnership firms, limited liability partnerships, not registered under the Companies Act. I have not followed what is meant by the LLPs not registered under the Companies Act. A LLP to come in existence, it is required to be registered under the Companies Act. But what the guidance note says is LLP is not registered under the Companies Act. Then in respect of the trust, then in respect of the societies and NGOs, and in respect of the professional firms, that is lawyers, doctors, chartered accountants. But it was clarified that in respect of the trust, the format is prescribed under the Maharashtra Public Trust Rules. Format for final statement has been prescribed under the Maharashtra Public Trust Rules. And therefore, in under a act, if there is some format prescribed, then the format as suggested in this guidance note will not be applicable. Therefore, this format will be applicable for sole proprietorship entities, partnership firms, LLPs not registered under Companies Act, then societies, NGOs, and professional firms. So now, does it mean that any final statement, balance sheet, profit and loss account, income and expenditure account, etc., prepared without considering the format prescribed under this guidance note will not be accepted as the final statement? That is not the intention of the guidance note. The guidance note says, whether that particular traditional balance sheet, whether it will be accepted by the income tax authorities, the answer is yes. Means any balance sheet, any final statements prepared without considering the guidance note principles will be applicable, will be acceptable to the tax authorities. Then why this is prescribed? This is mainly prescribed in order to be a comparable format, where it is required to be compared. So a comparable format is one proprietorship concern of a particular trading, of a particular business is to be compared with the other proprietorship concern of the same business. Or the bankers, financial institutions, they are required to finance such entities. While financing, they are required to judge the financial affairs of that particular concern. So that banker or the financial institution, they should be able to compare, they should be able to judge correctly the financial strength of a particular concern. In order to have basic intention in mind, this particular guidance note has been published by the Institute of Chartered Accountants of India. The purpose is to have transparent, useful, and comparable. So we have discussed comparable. Transparent is there should not be any hiding from the financial statements by the particular concern. Then it should be useful, it should be used, the person who is looking to the financial statement should be able to use that particular statement in a particular manner. And therefore, this particular guidance note has been issued. Now, it was the claim of the institute, and it was correct, that there was inconsistency in presenting the final statement of accounts. The final statement of accounts, other than of all the corporate entities, were not consistent, was having lack of transparency. It is not that they are giving the proper disclosures in their final statement of accounts. What are the disclosures required? That we will be discussing, and after we discuss the FAQs issued by the Institute of Chartered Accountants of India. So, while preparing the final statements, even when this particular guidance was not there, still while preparing a final statement, while signing a final statement, while presenting a final statement, there should be some disclosures by the person concerned who is signing the balance sheet. Means in respect of the proprietary concern, the proprietor; in respect of the partnership firm, the partner; in respect of the NGO, the responsible officer, the etc. They should declare the basis on which these financial statements have been prepared and presented. However, it was found by the Institute of Chartered Accountants of India that this is not there, and therefore the institute has suggested some formats for presenting the final statement of accounts. The key features of these financial statements are new classifications of assets and liabilities. I will give you a classic example of this. The example of this is, we know that in respect of the asset side, we have fixed assets. That is, now these fixed assets will not be called as fixed asset, but it will be non-current assets. You will say, what is this? Fixed assets are fixed assets. Why he is talking like this, that it is non-current assets? But the nomenclature has been suggested to be changed by the Institute of Chartered Accountants. And therefore, now non-current asset means the fixed assets, immovable properties, depreciable asset, etc., that are now termed as non-current assets. Then the institute has suggested that unlike corporate entities, you must have came across the profit and loss account, income and expenditure account of the corporate entities. In respect of corporate entities, the expenditure in respect of the finance charges is grouped under one head, and that is known as finance cost. Rightly so. This finance cost is the interest paid to the financing banker, interest paid to the NBFC, if any, financing to that particular company, then interest paid to on some unsecured loans taken, etc., that all will be clubbed together, and all these interest, bank charges, etc., charges on getting the loans, etc., that will be termed under the head bank finance cost. Now, in unlike this, in respect of a partnership firm, these particular finance cost will definitely be termed, will definitely be grouped under all these expenses towards bank interest, then interest paid to non-banking financial institutions, charges paid on renewal of cash credit, charges paid on getting new loans, then other charges paid to banks or non-banking financial institutions, that will be clubbed together, and that will be definitely called as finance, cost of finance. But here, the suggested format of the institute says that the interest on capital, if any, paid to the partners, that will also be termed under the head finance cost. I have not found any logic in terming the interest on capital as the finance cost. Interest on capital is definitely not a finance cost. That is what I feel. But the suggested format of the institute suggests so. And now, if we prepare the balance sheet, we have to prepare such balance sheet. So now the balance sheets prepared after 1st of April 2024 for financial year 24-25 will be are required to reflect these heads, the expenses and the heads in balance sheet as suggested by the institute, in the guidance. Then the financial statement should also reflect the overview of base value. If any concern has invested in some shares, then the base value generally it should be the cost of purchase of the shares. However, the present format as suggested by the institute also requires that the market value of such shares are required to be reflected in the balance sheet. Now, there is no column where the market value is required to be shown in the balance sheet. That is correct. But it is required to be declared by way of the notes on notes to accounts by the concerned institution, the sole proprietorship or partnership, or the NGO or the professional firm. That is the suggestion of the Institute of Chartered Accountants of India. PPT. The institute has given 30 FAQs for the institute has published FAQs in respect of the guidance note published by them. The first FAQ is what is the ICICI guidance note on financial statements of non-corporate entities? It is authorized document prescribed standard formats for preparation of financial statements for non-corporate entities. This is mandatory from financial year 24-25. Therefore, from 1/4/2025, any balance sheet for the period ending on 31st March 25 and onwards will require that it should be prepared in these particular suggested format. The guidance note, whether it is mandatory or recommendatory, so the guidance note is mandatory if and only if the chartered accountant is required to sign such balance sheet. Now, here some important things are required to be discussed. Now see, if we are preparing a balance sheet in the way we are preparing it till today, so we will be preparing our balance sheet, our financial statement for as at 31st March 25 and onwards in the same way without considering this particular guidance. Will it be invalid? That will not be invalid. But this will not be invalid, but this is if this particular statement is required to be signed by the chartered. Now see, where a chartered accountant is required to sign, when there is a compulsory audit. If there is some tax audit requirement is there, then the chartered accountant is required to sign. Therefore, in case of all compulsory audit cases, this suggested format is obligatory, compulsory. This particular format is obligatory, compulsory in respect of all the audited final statement of accounts. Now see, take a case of a proprietary or partnership concern where the turnover is only rupees 85 lakhs. So question of audit doesn't arise. It is not a professional entity. So in that case, audit is not required. And still, whether this particular format is compulsory. It is not compulsory, but this proprietary concern having turnover of rupees 85 lakhs is going for a loan or cash credit facility from some financial institution. Then that particular format which we are preparing traditionally will not be accepted by the financial institution. If at all that financial institution's authority is not knowing about this particular guidance note or about this particular format which has been suggested by the Institute of Chartered Accountants of India, still that institution, if that institution wants you to get it signed from a chartered accountant, then the chartered accountant will not sign on that. If a chartered accountant is signing on such a statement which is not prepared in accordance with the guidance note, then he is subject to the disciplinary action. So, no chartered accountant will sign on this. If at all, the chartered accountant wants to prepare some different format or that particular concern, proprietary partnership, etc., requires him to prepare their final statement of accounts in some different format, then the chartered accountant has to give explanation to the institute that he has varied the format suggested by the institute and he has prepared in some other format because the particular entity was having such particular features, and therefore it is required that he should prepare his final statement in that particular form. And so this is the basic requirement, the basic thing in respect of the preparation of these particular statement, whether it is mandatory or recommendatory, that I told you. Now, who must comply with the guidance note? The entity or the auditor. The responsibility lies with the auditor, chartered accountant in practice, not directly by the institute itself. See, the institute, the proprietary or partnership concern, they will definitely say, we are not the technical experts and therefore we are not knowing how to prepare and what is the guidance note suggests, is the guidance note of the institute suggests, and therefore we are not responsible. But the chartered accountant signing such statement, he is definitely responsible and he will be he will have to comply as per the guidance. Then if at all the CS signs such statement which is not prepared in accordance with the guidance note, then the CA must qualify the audit report or else may be subject to the disciplinary proceedings by the institute. Then does the guidance note override the earlier technical guide? See, before this guidance note, the institute has published a technical guide in respect of preparing the final statement for non-corporate entities, and that technical guide is overriding. That technical guide is not this guidance note is superseding, and the technical guide is not superseding. The guidance note is superseding the preparation of financial statements as suggested by the institute. What kind of entities fall under these guidance note? That we have already discussed. If law or regulatory practice, it works its own format. That also I have discussed, that if in respect of Maharashtra Public Trust, there is a specific format given by the trust, Maharashtra Public Trust rules, and therefore that is applicable, then this particular format as suggested by the institute is not applicable. Does the guidance note apply to both the business and non-business entities? The answer is yes. If at all it is NGO and it is a non-business entity, still the guidance note is applicable. It is also applicable to lawyers and professional firms, etc., etc. Then is the technical guide on NPOs mandatory? No, the technical guide does not have the authority of the ICICI Council and serves as a reference only. So it serves as a reference only, which should take precedence. The guidance note or technical guide, the guidance note presides and the technical guide doesn't. Does the guidance note support financial statements tailored for NPOs? Yes, the guidance note expressly allows flexibility as suggested in the Maharashtra Public Trust rules. Then can the technical guide still be used? Yes, the technical guide can be used, but it is subject to the guidance note issued by the institute. Why is the guidance note considered more authoritative than the technical guide? Because the guidance note has been formally approved by the Institute of Chartered Accountants of India, and therefore it is considered as authoritative, and technical guide, since it is not approved by the institute, it is not considered as authoritative. Then is the guidance note applicable for financials used for bank loans and subsidies? Yes, if those financials are attested by a chartered accountant. That also we have discussed, that if a chartered accountant attests the financial statements to be sent to the financial institution, then it is applicable for a financial institution also. Is the guidance note applicable in case of internal financial statements? It is not applicable in respect of the internal financial statements. So those statements which are published, which are given to outsiders, for that only this guidance note is applicable. And if you are reporting from junior to senior or senior to the managing director, etc., etc., then this the guidance note issue is not applicable. Then if a tax audit report is belatedly issued, say on 5th of April 25 for FY 23-24, is guidance note compliance necessary? It is not necessary for the financial statements prepared up to financial year the 31st ending on 31st March 24. So it is applicable for financial year 24-25 and onwards. What happens if a CA refuses to use the guidance note? The CA, if it is not using the guidance note, he must justify his action that whatever I have prepared is prepared in the following situation, and he should be able to justify that. Is the guidance note applicable to entities availing audit exemption under Income Tax Act? Only if other attestation is carried out by a chartered accountant. So if the chartered accountant is attesting other attestation, then this guidance note is applicable. Can a CA use technical guide formats instead of guidance note? So the CA cannot use the technical guide formats instead of the guidance note format. Then can a trust or NPO use income and expenditure statement in place of profit and loss account? The answer is definitely yes. Say in respect of NPO, it is they are not for the purpose of profit, and therefore the profit and loss account is not applicable for them, but it is income and expenditure which is applicable for them, and therefore this in respect of NPO, this particular guidance note is expressly allowing the substitution. Then is a balance sheet still required for NPOs under the guidance note? Yes, all entities including NPOs must prepare a balance sheet as per the guidance note. All in respect of all entities, the balance sheet is required to be prepared as per the guidance. Can NPOs adopt technical guide disclosure practices while using guidance note formats? The disclosure practices as in the technical guide may be adopted. However, the format provided in the guidance note should be used. What if a state government department insists on using technical guide? If no formal format is prescribed by law, the guidance note shall prevail. However, dual presentation may be provided for reporting conveyance. If at all, a state government authority is insisting on the old technical guide format, then that particular concern can present both these, the format in the presented, balance sheet presented, final statement presented in the technical guide format, as well as the final statements prepared as suggested by the guidance note. Is receipt and payment statement required under the guidance note? Not compulsory. Receipt and payment is not compulsory under the guidance note. Then can guidance note formats be adapted to suit the entity size and operation? Definitely yes. The guidance note format. See, we will see the detailed balance sheet and the profit and loss account as suggested by the institute. It is on the basis of a big turnover entity. However, in respect of the small entities, the suitable format, but not overriding the guidance note, should be the final statement could be prepared. Then, can export sales be shown in USD in the notes to accounts? The answer is yes. In notes to accounts, the export sales in the US dollar could be deflected. Then does the guidance note allow grouping of owners fund for partnerships and HUFs? Yes, the guidance note includes flexibility to adopt owners capital, reserves, drawings, etc. per entity per constitution. So it is allowed by the guidance note. Then Is a comparative column for prior year figures mandatory? Yes, except for the first financial year. Not the first financial year. Do you mean that the first financial year is 31st March 2025? It is not so. The guidance, the balance sheet, final statements are required to be prepared for financial year 24-25 in the format suggested by the institute for the first time in FY 24-25. But the previous year column is not compulsory in respect of a partnership firm, in respect of a proprietary concern, or in respect of an NGO, where the first year of that particular institution is 31st March 25. In that case, the previous year figures are not compulsory. In all other cases, the previous year figures are compulsory. So with this, I have tried to discuss the FAQ published by the institute. There also, the institute has, in respect of the profit and loss account, they have used the other terminology, revenue from operation. See, what we know, every one of you know that where to write sales, where to write the professional fees, that every one of you know. I am not required to tell you that. But now the suggested format of the institute is like that. It requires that the sales, then professional fees, other income, discount, incentive, interest on bank accounts, etc., is required to be shown under the head revenue from operation. So it is, the terminology is changed in respect, not in respect of the balance sheet, but it is changed in respect of the profit and loss account also. So there also the revenue from operation is required to be shown in the format as we discussed just now. So with this, we have discussed the FAQs, and now we will go to the actual format of the balance sheet as suggested by the institute. Friends, the institute has suggested some formats of the final statement of accounts. It is in the format of, it is some different format. What we are acquainted with is the T format of the balance sheet. However, now it is the format has been changed by the institute, and it is unlike the format of a corporate entity. So in respect of the balance sheet, first equity and liabilities, there the owner's funds are required to be reflected, shown, and how you have arrived at the figure of owner's funds, that is required to be detailed in the attached note. And therefore, for each figure which is reflected in the final statement, you should have the detailed note reflecting how you have arrived at that particular figure. Then reserves and surplus. In respect of a proprietary concern, the concept of reserves and surplus is actually not there. However, if at all some reserves and surplus have been kept separately in the balance sheet, that could be reflected over here. Then non-current liabilities, it is long-term borrowings, then deferred tax liabilities, other long-term liabilities, long-term provisions. Each head is the broader head which is being reflected in the balance sheet, and the detail of each of that is required to be shown by way of the note at forming part of that particular balance sheet. So here the format has been prescribed by the institute, which I am presenting before you. Now, these assets, we have already discussed that the fixed assets are termed as non-current asset. So, what is non-current asset? That is property, plant, equipment, machinery, intangible assets, then capital work in progress, etc., that are non-current assets that is required to be shown to the asset side. So, see, this particular format has been suggested by the institute, and that we have to prepare the balance sheet in this particular format only. The first column is in respect of the particulars, then note number, corresponding note number, then the current year figure, 31st March of the current year, then the previous year figure, 31st March of 2024, previous year figure. Here, previous year is not as defined under the Income Tax Act. Income Tax Act defines previous year separately. This is the previous year, is the previous financial year as meant in respect of this particular balance sheet. So this is there. We will not be discussing each and every part of this, but this is the prescribed format which you will be getting on your from the association on your WhatsApp, so that you will be able to go into the details of that. Now we will be going to the other statement, profit and loss account. We have discussed that the credit side of the profit and loss account is required to be reflected as other revenue from operations. So this revenue from operation is the revenue which the particular institution entity has received. Then the smaller heads, other income, in respect of the interest or small discount, etc., that will be reflected under the other heads. Then expenses, what we are fond of, what we are doing is we are showing the opening stock to the debit side, then purchases to the debit side, and we are showing the closing stock to the credit side below the head sales. However, now the format now prescribes that under the head expenses, cost of goods sold is required to be shown. So what is cost of goods sold? It is the purchases, then direct expenses, then opening stock, and then deduct there from the closing stock. That will be the cost of goods sold. So the presentation method has been changed by the institute. Again, the column is particulars note number corresponding what the figure which we arrive at in the final statement of accounts for the current year, that is required to be reflected after the next column to the note, and then in the very next column it is the previous year figure. Previous year as it is not as defined under the Income Tax Act, but previous year is the year immediately preceding the year of which you are presenting the final statement. So that way it is required to be reflected, that way it is required to be shown in the books of accounts. Then we have discussed sometime earlier that the finance cost, there the interest on capital paid to partner is reflected under the finance cost. Then the partner's remuneration is required to be reflected. All these are the present statement. All these are the ways of preparation that has been suggested by the institute. Now, notes to accounts. We have discussed that while we prepare the balance sheet, while we preparing the final statements, we are required to have the notes to accounts, which on the basis of which we have prepared the final statements. So what are the notes to accounts which are required? The first note which is required and should be there is the final statement is in respect of the proprietary concern of Mr. So-and-so, or it is this is the final statement of a particular HUF, or this is the final statement of ABC partnership firm. That way, that note should be there. That should be the note number 1. Then, how you have valued the stock? Stock is always required to be valued at cost or market price, whichever is lower. So you are required to write that the stock is valued by that particular entity at say cost. Then thirdly, if the certifying authority, chartered accountant, or whether he has physically verified the stock, that he has to write over there. If it is not physically verified by him, then he has to comment on that this particular stock is verified by the proprietor or the Karta of HUF or the partner or the managing partner of that particular partnership firm. If that particular stock is having some items which are obsolete, unusable, then that is also should be required to be reflected, suggested in the required to be written in the notes to accounts. Then the notes to accounts also should write that the advance, if any, received by the particular concern. That particular concern, he has received order advance, and that the particular concern has not complied with that particular order, or that particular service is not completed on the date when the final statement of account is prepared. And therefore, that is reflected as the liability to the liability side. Now, till the date of preparation of accounts, I am trying to tell you that your balance sheet is as at 31st March 2025. You are preparing balance sheet on 31st of July 25. So you are required to write in the note that the XYZ amount of advance received reflected in the balance sheet is that particular order or that particular service has been provided subsequently, and that particular liability is now not there, or has been partly complied, has not been complied. Whatever, that is required to be there in the notes to accounts. Then in respect of the advances given by the entity, that is also required to be reflected in the same way as in respect of the advance reflected to the asset side. It means that if you have given some advance for getting a particular service, or if you have given some advance for some order of getting some particular goods, then whether that particular order has been complied by your supplier or not, that is required to be reflected in the notes to accounts. Then now the balance sheet which is prepared from the majority used software is Tally. So the balance sheet which is printed from the Tally and got signed from the chartered accountant will not suffice the purpose of this guidance. And therefore, that particular balance sheet will not do, but you have to prepare the balance sheet in the Excel format, or it is not suggested that it should be in Excel format, but it is required to be prepared in a format, and therefore that particular balance sheet should reflect the details of all the assets and all the liabilities. What is the details in respect of the liabilities? I'll tell you. In respect of a particular concern, it is enjoying a loan. What we write is Bank of Baroda loan. That's all. It should not be so. It should be Bank of Baroda, Bajirao Road branch, property loan account number A, B, C, D, E, F, G. That should be the way of presenting the balance sheet. Then you are enjoying a cash credit facility. Therefore, your balance sheet should reflect XYZ Cooperative Bank Limited, so and so branch having cash credit account number so and so. Or you are enjoying some overdraft limit from the bank, then it should that balance sheet should reflect overdraft account number so and so. That way, it should be the preparation of balance sheet should be there. Now, I have just talked about the summaries balance sheet being printed from the Tally software. Tally software reflects bank accounts and then the bank balance, say 10 lakh rupees. Whether you are holding one account or whether you are holding 10 bank accounts, that is not detailed in that particular balance sheet. But your balance sheet should reflect ABC Bank, XYZ branch, SB account number so and so, then the PQR Bank, XYZ branch, and current account number so and so, etc., etc. All that is required to be reflected in your balance sheet. So this is the requirement while preparing the balance sheet. Also, in respect of a builder firm, I'm taking an example of a builder or developer firm. A builder firm or developer firm, they are purchasing a land, then getting it developed, and then constructing that particular site, and then they are selling those flat shops, offices, etc., etc. So during the period, it is not that every construction activity is started on 1st of April and completed on 31st March. It is not the case. And therefore, construct that part, acquisition of land, passing of the plans, then construction activities starting, part construction, part completion, then part possession, part booking, etc., etc. All these phases are there in respect of a builder. Now, during the course of construction, during the progress of construction, this is your capital work in progress. This is your stock of WIP, work in progress in stock. And therefore, that is required to be reflected under the head stock, work in progress, construction in progress. That is required to be reflected. Now, in respect of a factory under construction or factory under development, the shed is there, the the factory has got electrical connection. However, the machinery installation was in progress, but not completed as at the date of completion of, as at the date of preparation of balance sheet. Say on 31st March 25, the machinery was not fully installed. Then that particular item expenditure in respect of the investment in this particular machinery is required to be reflected as capital WIP under the head capital WIP under the head assets, current assets. So this way, the preparation of balance sheet and profit and loss account is required to be presented henceforth in respect of all those entities who are getting the accounts signed from the chartered accountant. In case these entities are signing these particular final statements on their own without the signature of a chartered accountant, then this particular format is not compulsory, but this format is compulsory if a professional chartered accountant is signing. Otherwise, the chartered accountant will be subject to the disciplinary action by the institute. This is what this is what in respect of all the subject which has been allotted to me. I have tried to give you all the details in respect of the subject allotted to me. While preparing this particular presentation, I have been guided by one of my friend, Chartered Accountant Uday Kukde, and I'm thankful to him and his staff, along with all our association managing committee. They have asked me to prepare on this particular subject and present it before you. I have tried to present the details before you to the best of my ability. I am thankful to you and the managing committee for giving me the patient hearing. Thank you. The schedule like debtors, creditors in previous year party-wise figures are required. Yes, in respect of these schedules also, the previous year figures are required to be reflected in the schedule to the final statement of accounts. Someone has just commented that it is more than a tax audit report. Friends, this is the format suggested by the Institute of Chartered Accountants of India in respect of non-corporate entities, and it is the information as suggested at the moment is like that only. However, you can change the format, you can fit the format in the in respect of your own entity as per your own understanding and as per your own practical way. There is one question. As per guidance note, fixed asset has to be stated gross amount. Sole proprietorships does not have gross amount of fixed asset. Then how to comply with the guidance note? In respect of the fixed asset, I am having the same question. But however, in respect of the fixed asset, our schedule is reflecting the previous year figures, opening balance, then the addition made during the year for less than 180 days, more than 180 days, and the closing balance after the depreciation. Therefore, the gross amount or the date of purchase is not required to be suggested. This is my interpretation. This is required to be confirmed with the practical issues. Is the format applicable to proprietary concern turnover between 1 crore to 10 crores? Friends, this is applicable to all who are under tax audit. Your question means that the turnover is up to 10 crore, but the tax audit is not applicable to that particular concern, Mr. Lotlikar. But see, if at all tax audit is not applicable, still, if you want to get this particular finance statement certified from your chartered accountant, then the previous year figures are compulsory. If you don't want to get this certified from the chartered accountant, then the income tax authorities, GST authorities will not ask for the previous year figures as the updation of the law at the moment. If the assessee is filing ITR under 44AD or 44ADA, still it is Atulji, there is a misconception. I always say that in respect of 44AD or 44ADA, accounts are required to be prepared. So you should have the accounts. It is the misconception that in case a 44AD ITR is filed or 44ADA ITR is filed, then the books of accounts are not required. That is not the case. I always say that in respect of 44AD or 44ADA, still the accounts are required to be there, and therefore if you want to get your balance sheet certified, then it is required to have the previous year figure also. Then whether disclosures of terms and conditions of bank loan sanctioned are required. Friend, at the moment, whatever the guidance note suggests, it is not the terms and conditions which are required to be reflected. If at all the institute suggests so, then our balance sheet will be a bulky balance sheet running in number of pages, say 100 or so. Anyway, I have tried to answer all the questions which are there in the chat box.
Sir, can I ask one?
Yes, yes.
Sir, in case of a trust, there is a specific format for income and balance sheet.
Yeah.
It's a deferred.
Yeah.
So in which format we can prepare income and balance sheet?
This is very much specified by the institute that in respect of the trust, it is not required to follow this particular format, but it is as per the format as suggested by the Maharashtra Public Trust Rules, and therefore you can definitely prepare the accounts in that format and not the format suggested by the.
Because this format is also signed by the chartered accountant.
Though it is signed by the chartered accountant, the exception has been provided in the guidance note itself, and therefore no issue will come.
Thank you, Sharma, sir, for nice and informative lecture. Now I request our committee member, Ashwini Bidkar madam, Ashwini Jadhav madam, to formal vote of thanks.
Thank you, sir. President Advocate Aniruddha Chauhan, sir. Chairman Milind Hendre, sir. Joint Secretary Kailash Kashin, sir. Committee member Ashwini Bidkar, madam. And today's faculty Santosh Sharma, sir. Dignitaries of the dais, on the dais, and all virtual listeners. Sir has delivered very fruitful lectures on today's subject, financials of non-corporate entities, with the help of the FAQs, and also give the satisfied answer for all the questions. So on behalf of the MTPA, I thanks to sir. Thank you so much, sir. And thanks for this opportunity. Thank you.
Thank you, Ashwini madam. With the permission of President, I declare that this study circle meeting is over.